2 years ago, Ola Electric looked almost unstoppable. At one point, nearly one out of two electric scooter being registered in India was an Ola. Its market share had jumped from roughly 6% in FY22 to 21% in FY23 and almost 35% in FY2024. Revenue was exploding, deliveries were exploding, and investors were being sold a very powerful future. Ola could become the dominant electric two-wheeler company in India, but today the question is completely different. How did the company with roughly 35% market share eventually fall to just 5.1% in quarter 4 financial year 2026? And here is what makes this story much more deeper than simple bad service or falling scooter sales. When I went through Ola's financial statement, IPO prospectus and investor presentation, another problem became visible. Shareholders' return were deeply negative. Capital was being consumed, profitability remained absent, and the valuation had assumed a future that Ola had not yet delivered. And this is where the real share price story begins. First, understand just how quickly Ola grew. Revenue from operation increased from only around 373 crore in FY22 to 2631 crore in FY23 and 5010 crore in FY 2024. Delivery jumped from roughly 21,000 to 1,56,000 and then 3,33,000 vehicles. Market share simultaneously rose from 5.7% to 21% and then 34.8%. On surface, this looked fantastic, but underneath, profitability was telling a completely different story. Ola's EBITDA margin was approximately minus 157% in FY22, minus 43 in FY 2023, and minus 19.8 in FY 2024. Yes, margin were improving dramatically, but they were still negative. In simple words, Ola was becoming much more bigger, but the business was still losing money. And this is extremely important for shareholders. Growth is valuable only if eventually that growth converts into profit and cash. Otherwise, every additional year requires more capital, and Ola's own prospectus reveal just how expensive this growth has already become for the people funding the company. This brings us to one of the most important number that was missing earlier, ROE or return on equity. Think of ROE very simply. If shareholders give a company rupees 100, how much profit is the company generating from that 100 rupees? A good profitable company produces positive return. Ola was producing the opposite. According to its own IPO prospectus, return on net worth was minus 21.42 in financial year 2022, negative 62.47 in 2023, and 78.46 in FY 2024. That means by FY 2024, for every 100 rupees of year-end shareholders' net worth, Ola generated roughly rupees 78 of annual loss. And look at what happened to equity. Total equity declined from approximately 3,661 crore in 2022 to 2,356 crore in 2023 and only 2,019 crore in FY 2024, primarily because of losses. So while revenue was growing rapidly and market share looked fantastic, shareholders' capital was being eroded underneath. This is where the difference between popular company and a financial productive company becomes very important. Then came the IPO and valuation changed the entire equation. Ola's IPO was priced as 76 per share with approximately 441 crore shares outstanding after the offer. That implies an IPO equity valuation of roughly 33,500 crore. Now compare that with FY 2024 revenue from operations of 5,010 crore. Investors were effectively valuing Ola at roughly 6.7 times annual sales, even though the company was loss making. And because FY24 earnings per share were roughly minus 4.35, a normal P could not be even meaningfully calculated. There was no positive earnings denominator. It gets even more interesting. Ola's prospectus showed FY 2024 net asset value of only around 5.54 per share against rupees 76 IPO price. That was roughly 13 times FY 2024 book value. None of this automatically means the IPO was wrongly valued. It means investors were paying for enormous future growth, future market leadership, and future profitability. And when you pay for the future, disappointing that future becomes extremely expensive. And then the operating story started moving in exactly the wrong direction. By 2024, service problem had become impossible to ignore. Ola disclosed that the Central Consumer Protection Authority had forwarded 10,644 consumer complaints. Although Ola later said 99.1% were resolved to customers' complete satisfaction. But service created something more dangerous than repair cost. It damaged trust. At the same time, TVS, Bajaj, and Ather were becoming much more stronger. Ola was no longer attacking sleepy incumbents. It was fighting companies with established dealer network, spare part system, and decades of automobile experience. The result eventually appeared in the volume. Ola delivered around 359,000 vehicles in FY 2025, but only about 174,000 in financial year 2026. Revenue from operation fell from 4,514 crore in FY 2025 to 2,253 crore in FY 2026. So the future on which the valuation depended, continuous scale, leadership, and eventually profitability, was moving further away. And now the financial ratio became even more important. Look at shareholders' return after the IPO. Ola reported a consolidated loss of approximately 2,276 crore in FY 2025 and 1,833 crore in FY 2026. Total equity stood at around 5,143 crore in FY 2025, helped significantly by the IPO capital raise, but fell to approximately 3,351 crore by FY 2026. Using the same simple methodology Ola used in its prospectus, annual loss divided by year-end equity, that gives us an approximate ROE of minus 44.3% in 2025 and minus 54.7% in 2026. In other words, despite receiving billions of rupee of fresh shareholder money, the company was still generating deeply negative return on that capital. Now consider ROCE, return on capital employed. This asks whether both shareholders' money and borrowed money are being used productively. Using a standard EBIT divided by equity plus borrowings approximation, Ola's consolidated ROCE was roughly negative 23% in 2025 and minus 25% in 2026. Negative ROE tells you shareholders are losing accounting value. Negative ROCE tells you the wider capital base still is not producing an operating return. And now you can understand the share price pressure much more clearly. Ola raised approximately 5,275 crore of net fresh IPO proceed, but the business continued reporting major losses. Then in June 2026, Ola returned to the equity market again and raised approximately 780 crore rupees through a QIP. Here is the striking part. Those new institutional shares were issued at 35.86 each. Compare that with the IPO price of 76 rupees. The QIP issue price was roughly 53% below the IPO price. Now, this was a QIP transaction price and not necessarily the stock's exact market price on every trading day, but it is still a powerful reference point. It also increased shareholders outstanding from approximately 441 crore to 463 crore, which means existing shareholders were diluted. So investors were facing three things together: continuing losses, weaker operating performance, and additional equity issuance. That is why valuation matters. A high growth stock can survive temporary losses. What it struggles to survive is repeated downward revision of the future investors originally paid for. But the story has an important twist because Ola is not simply getting worse. FY 2026 was called a reset year, and some operating numbers have genuinely improved. In Q4 financial year 2026, consolidated gross margin reached 38.5% versus 13.7% in Q4 FY 2025. Operating expenses fell from around 844 crore to 428 crore, and Ola reported its first positive consolidated operating cash flow quarter of approximate 91 crore. Then in Q1 financial year 2027, deliveries reached sequentially from 20,256 to 39,192 vehicles. Revenue increased from 265 crore to 455 crore, and market share recovered from 5.1% to 8.4%. Operating expense fell further to around 333 crore. These are the real improvement. But notice the difference between improvement and shareholders' return. Better gross margin does not automatically mean positive ROE. Higher deliveries do not automatically mean positive ROCE. For the valuation to sustainably recover, Ola ultimately needs positive operating profit, positive free cash flow, and positive return on enormous capital already invested in the business. Positive side is that gross margin are improving, costs are falling, service metric have improved, the distribution model is changing, and battery cell integration could eventually create a genuine cost advantage. But this is now the metric I would watch above everything else. Can Ola turn growth into sustainable positive ROCE and ROE? Because market share tells you how many scooters Ola sells, revenue tells you how big is Ola, but ROE and ROC tells you something much more important: whether Ola is actually creating wealth from shareholders' money, and that will decide whether this is turnaround or simply a cheaper version of the same story. Thanks for watching. Please don't forget to subscribe the channel, like the video. If you have any questions, please put in the comment section. See you in the next video. Take care. Bye bye.